Welcome back to another AriasWave video. Video idea. It's an idea. That's what it is. Um, I haven't posted for a while, in case you haven't noticed. And I've just been sitting back, watching, thinking, thinking about, for almost 6 months or whatever, however long it's been, about what's happening in the economy, what's happening with rates. All right. So this is the important thing that I'm going to share here today. And I haven't wanted to post anything unless I had something, a new revelation or a new idea on these patterns, right? Because it's very hard to distinguish these patterns, right? And it's super mega difficult to try and just produce an idea and just pull it out of thin air, right? But I started to think about, from a fresh perspective, after observing for a long time, I started to apply the knowledge again to the Dow Jones, but simultaneously the bond yields, right? The US 10-year long-term pattern. And I'm going to show you that in a minute. But before I get there, I want to sort of highlight a couple of things on this chart, right? So I suppose the first thing is the Great Depression. The Great Depression, in my opinion, still seems to be at this stage that it was a sea wave, right? Just a large, massive crash, sea wave, one of the biggest in history. So, what happened after that was a reaction. Um, you know, yes, the gold standard was removed at some point, 71, but this bounce back, it's something that I've noticed that happens a lot after these crashes. And I think that this is a monstrosity of a bounce that's occurring long term. So having to sort of mull over that, marinate on that for a long time, suddenly I started to realize that I'm thinking too small, right? I'm thinking small. I'm not thinking big. And this is big, right? This is a big, big move since the Great Depression. It's gone up. So what is it? If it's a C down the bottom, then it must be a D moving up. So how can that possibly pan out? And where did the A wave end? So taking a logical approach, I thought to myself, well, it appears that even the Ellioticians thought that after 2000 there was going to be a massive crash, right? But I think that the problem with Elliott wave is that they assume that things just move up in five waves and then just reverse the opposite direction in a big way, etc. This and that. But this is AriasWave, right? I created AriasWave for a reason, is to understand the potential for the corrective portions of zigzags to occur. So I suppose what I'm trying to say is we had an A wave of a zigzag D, a big one, right? And from what I've noticed in the markets, due to, I don't know, government intervention, Federal Reserve Bank intervention, these moves can be gigantic, right? To say the least. So if I'm to assume that this is just a long-term pattern and we've seen half of it almost completed, then this is a wave of a larger D wave unfolding. And that basically takes us to where we are now, right? Since 2000, it is my opinion that we had an A, B, C. GFC was a wave C, right? And everything since then has been, once again, a reaction to a crash, right? Now, this is a smaller scale reaction, and this is definitely an expanded wave D zigzag. Well, in my opinion, it is, right? But just because, well, when I created AriasWave, I discovered that there's always a set of corrective patterns that occur in a specific order with some of those components expanding. So there's 5-wave moves and zigzags, right? So for example, the B wave here, it didn't expand too much, right? But the D wave did, right? And that's fine. It's like a version of alternation between corrective patterns, right? This is purely AriasWave talk that I'm saying right now. So it seems to me like, okay, for starters, I would never call this an impulsive 5-wave move. This is what happened since the GFC. I just can't call it that. It doesn't make any sense, right? All I can see is a bunch of corrective patterns, and it's within a zigzag, wave B, right? Now, this is open to interpretation. It's subjective. It is. Like, I must admit, there are some parts of what I do that can be very subjective. But I'm going to present to you an idea here that will make you think a little as to, is there a potential case for the market correcting back substantially? We're talking worse than the Great Depression percentage-wise. Instead of 89%, we're talking 98%, right? Now, within this D wave pattern, which is also not easy to, pull apart and identify each wave correctly, I have taken into consideration a few things that are going on in order to sort of align them somewhat. I'm not trying to form fit, but somewhat align and just bring my perspective now that I've come back and want to start sharing things, because I do believe that this will have repercussions for other markets, and that includes crypto and precious metals, etc. So having had this expansion of a wave D, and if the internal portion of that has been identified correctly thus far, then it would be my opinion that if we hit 50,000, roughly 50,000 in this market, we're going to see the start of wave E down for the B wave of the zigzag, right? This is a long-term pattern. So normally a zigzag in, I suppose, Elliott wave world, you've got like an A, a B, and a C. But in AriasWave world, that's not how it works. That's too basic. It's ridiculous, right? It's more like A, and then you've got A, B, C, D, E. And then you've got your other move higher. So there's 5 waves in the correction, right? So it's a lot more complex, and this is the reason why I'm making this video, is to just highlight that again, but also what kind of ramification does that have for this pattern, right? Now, not all zigzags are made equal, right? Sometimes you can have a zigzag that has an A, small a, B, C, large D, and then an E before you get that next 5-wave move, right? That's how I see it. They're not always the same. So what I'm trying to say here is that the bigger they are, the harder they fall. Not always, right? And that's why it's open to interpretation. It's subjective. And I'm going to tell you my opinion as to why I believe we are going to get that massive crash, right? And it's to do with interest rates, the debt market. Okay? So, okay, let's just say we zoom out a little, go back, we could see, the beginning of that move since the Great Depression. You got 5-wave move, 5 waves up, right? You've got a small A, B, C, large D. Where's the E? Well, from observing markets and analyzing charts, I believe that markets do like a few things. One of them is corrections usually revert back to the previous the previous fourth wave of the previous third wave. Right now, Ellioticians might say that it's the previous fourth wave, right? But yeah, whatever. In this case, they're practically the same thing, right? But if you look back, you can also see the Great Depression wave B just before the Great Depression started. You can see the wave B high. So you've got like this support area. You broke out of it. You expanded somewhat, quite substantially. You created a wave, 4 of 3 and wave 4 and then 5, right? Whatever. That's great. So this is the area I expect it to fall back down towards within a wave B of a larger zigzag pattern, right? So that means that from 50,000, if that's the target, because it is according to that particular count, then you're looking at about 98%. It's a massive move, right? But the other thing is, well, when you break resistance, which would have been that, Great Depression wave B high, doesn't it come back to retest that? So that's a breakout. Doesn't the market typically tend to come back to retest a breakout? Well, I would say yes. And especially in this case, given the dynamics of the market and the way that it's kind of structured, right? And the reason I say that is if I just go back, because this is just how I did this particular presentation. I just wanted to do it this particular way. If I go back to the TNX chart, right? So I probably wrecked it already, but there it is. Great. So here we have interest rates on a long-term chart. Now I'll give you a moment to just look at that. Right, so you've got 1150 AD, like basically like quite a long time ago. You've got 1440. Now, in my opinion, then this is purely my opinion, that move down in the bond yields, which is obviously interest rates, if you look at it, this is basically an interest rates chart, right? It's the inverse is the bond yield, or it's the bond yield. I'm not really too focused on getting my terminology right at this point. It's basically the debt market in reverse, right? So interest rates go up, the debt market crashes, right? Now, I could show you another chart of another time where basically the market crashed due to interest rates going higher, but this video is already getting long. So if this is a wave C and this is a wave D, this entire move since 1440 right down to basically 2020, because this is an incomplete chart, was a wave E, right? Now, in AriasWave terminology and way of thinking, whenever a wave E completes of a wave B, you get a wave C, right? You get a wave C bounce. And the rule is that it has to make one high above all previous corrective patterns, right? So therefore, what we're looking at here is basically at least 20% interest rates. Now, if you think about how much debt is in the market today, This kind of aligns with the Dow Jones theory 98% decline, right? Now, this is just my opinion. You don't have to believe this. This is just AriasWave, just another opinion on the internet, just another guy talking about waves. But I have my own way of looking at the waves. Now, with this particular move, you could probably say, well, hang on a minute. What happened? You have incomplete data here. What if this is like the end of a wave A, this is a B, this is a C? Well, that could happen. It could happen. But given that the Dow Jones is in its current pattern, we're expecting a 5-wave move down, not a zigzag. Once again, it's just my opinion. We are looking at a 5-wave move up in interest rates, which would result in a massive 5-wave move down in the Dow Jones, which obviously would impact the global economy because all markets are kind of correlated, right? They are. And if we see this type of spike in interest rates, I believe that we will see this happen, right? Now, once again, this is just my opinion. Let's see what happens with the pattern. Now, sorry, I'll just bring that back for a second. So wave E having a 1, 2, 3 pattern, right? We had a 1, 2, 3. Wave 2 had a very basic, sharp pullback before wave 3 happened. So if you talk an alternation, well, you had wave 4 was extended A, B, C, D, E. So yeah, wave 4 did go into the price territory of wave 1 and 2. But that's allowed to happen in a weak 5-wave move, which is something that I also teach in the set of corrective patterns and their variations and what can happen. And there's only 3 per pattern. So that just means that move, which was very long, was a very drawn out, weak 5-wave move. But the thing is, it completed in 2020, right? So that's a very long-term build-up of pressure in rates for whatever reason, right? So the way that I count that is 1, A, B, C, D, E for 2. 1, 2, 3, and then A, B, C, D, E for 4. And mind you, these are zigzags. So it's a weak ending to a move, which results in zigzags. That's why it's so choppy. So 1, 2, 3, 4, and then 5 was massive. It's a zigzag. Now, we broke back above the end of wave 4, right? So that to me indicates a reversal. Now, interestingly enough, if you're looking at it from this perspective, since that 2020 low, we've only gone up 1,000%. But to 20% from here is only, 400%. Could it go higher? Well, it could. I don't know the future. I can't tell you that. But 20%, that's only 400% from here compared to the 1,000% rise since 2020. So what, you think that's impossible? Well, I don't think it is. It just doesn't make any sense. Why would it be impossible? Nothing's impossible in the markets, right? So this is my way of counting this move. It's a wave 5. It reversed, it confirmed, and that's why I believe the Dow Jones will see a significant decline because the debt will be flushed out and we will have, I suppose, mean reversion occurring. And I've run out of time, so hopefully you like it. I'll catch you on the next one. Ciao.